Recently, there's been a lot of worry about the dropping household savings rate in India. In fact, it's dropped like a stone from 23.6% of disposable income in FY12 to 16% in 2018. So, there have been discussions about how you can revive this savings rate. Some of the suggestions that have come up are whether you should allow people to hold so much gold or real estate and whether it's necessary to move them away to financial savings. The other suggestion is whether they should be asked to move to market linked products. But the problem is with market linked products in India, actually it is a very low income country. If you look at the CSO data, the average per capita income of the Indian is about 1.26 lakh rupees. That is how much a person makes in a whole year. There is also a recent report from Credit Suisse on wealth, and that says that the median Indian holds average wealth of just $3042, which is just about 2.1 lakh. At the subsistence level of income and savings, it is very hard for a person to actually take on any market risks with their capital. So, what can be done to bump up the savings rate? One good suggestion is to revive the small saving schemes that all of us are familiar with. So, what are the advantages of these small saving schemes? The first thing is they are run by the post office, India Post, which is a central government entity. So, all the small savings are collected and they go into something called the National Small Saving Fund. And the Small Saving Fund is a conduit for central government borrowings that makes it an absolutely safe investment. Secondly, these schemes offer only fixed returns. So, the investor does not have to track stock markets, bond markets or do any due diligence on the balance sheet of the person collecting the money. The third factor actually is accessibility. India Post has 1.55 lakh branches across India, and that is a branch network that no bank can hold a candle to. So, with all these advantages, why haven't small saving schemes emerged as a bigger savings option for the poor? It is basically because these schemes have been systematically neglected by successive governments over the years. So, how do you reform these schemes? Firstly, you could offer more schemes in the 10, 15 year and 20 year options so that people can park long term money in them. Secondly, the tax breaks which have been withdrawn on the interest receipts, they can be restored selectively, especially for schemes like the senior citizen scheme and the monthly income scheme. Cumulative options can be introduced on some of the schemes along with the income options. Finally, of course, the India Post itself has to be reformed with more digital operations and a better customer interface, so that customers do not find it difficult to transact in paper form or have to follow a lot of procedures in order to get through with their investments. So, what is the constraint to the small saving solution? Well, one constraint is that Indian banks have always protested against high interest rates on small saving schemes, saying that this will affect the flow of bank deposits. This criticism wears a little thin because today bank deposits are sitting on a total sum of about 127 lakh crore, whereas the post office saving schemes are sitting on a mere 9 lakh crores. So, the annual inflows that the bank deposits attract are far higher than what the post office manages. This is basically because very small savers frequent the post office. Secondly, many of the small saving schemes also have individual limits. On PPF, you can only invest 1.5 lakh a year. On the senior citizen scheme, there is a cap of 15 lakh a year. Finally, the government borrows 6 to 7 lakh crore every year from the markets in order to meet its budget gap, the difference between its expenditure and income. The benefit of having some of these borrowings routed through small saving schemes is that whatever the interest that the government pays on these borrowings, these can be enjoyed by retail savers and small depositors instead of going to fat cat institutions like banks, insurance companies or pension fund funds.